be developed by Alfred W. Jones. So this strategy is based on betting on both long positions and short positions. So you would bet on a stock that you think is stronger, and you take long positions on those shares, typically within the same industry, and then you also bet on a stock that you think is weaker. You'll take a short position on that stock. So, for example, Apple and Samsung. If you believe that Apple is a stronger, like phone technology brand, then you would take a long position in that, and then you'll also take a short position in Samsung if you believe that's weaker than Apple. And the reason why this strategy is pretty effective is that it reduces the market risk because the shorts offsets market exposure. So let's say if something happened to the world and then the stock market drops 50%, you don't lose out on all of the gains that you have on your investments, because the short positions make some return off the short positions, which kind of offsets all that loss. And then another hedge fund strategy is fixed income arbitrage, and this is based on investing on high leverage interest paying bonds typically. And the reason why it uses high leverage because the amount of money that you make in arbitrage is very minimal. So in order to even make very sufficient amount of money, you have to take very high leverage positions in order to make the minimum gains add up to something very significant. So what happens in this strategy is that this is also a market neutral strategy, since you're taking both short positions and long positions, just like the long short equity. And this is a bit different because you take short positions on overpriced stocks and long positions on underpriced stocks, and then well, not stocks, bonds, on interest gain generating securities. So the expectation is that you make money off of the differences, the inefficiencies in the market, so that if the overpriced stocks return to a more normal level and the underpriced stocks also return to a more normal level, you can make money off of that difference. Yeah, but typically arbitrage is very rare, and for this type of arbitrage, you're trying to buy assets on one market and then sell it in another market for a higher price. And the last strategy that I'm going to talk about is quantitative strategies. And this type of hedge fund uses quantitative analysis, which is the combination of mathematics, statistics, and research on large data sets in order to understand patterns that it sees in the market. So typically this is where you see the high frequency trading and the black box trading occur, where algorithms are created, and then these hedge funds just throw specific parameters into these algorithms that use mathematical models in order to determine whether or not it is a good investment. And then based on that, they could produce exact steps on what to do and how to trade these strategies. And some of the most successful hedge funds are actually quantitative hedge funds, like the Renaissance Technology, which is founded by Jim Simons, and it's known to be one of the most lucrative hedge funds in terms of annual returns, surpassing many